Holy smokes everyone, what an absolutely crazy year it has been in the markets. 2021 we saw a speculative mania frenzy. The S&P 500 rose 28%, house prices went crazy, we saw the rise of meme stocks and doggy coins, but it's now time to turn the page of 2021, and in this video I'm going to go over 7 signs and the 7 biggest risks that could lead to a stock market crash in January. Now this is not me predicting there's going to be a catastrophic crash in January of 80%, but these are the biggest risks for the markets that you should be aware of so you can figure out for yourself if you think now is the right time to invest. So everyone, let's not waste any time. Let's get into these 7 signs for the stock market in January. Now coming in at number 1 is Omicron and the supply chain issues. Many people in 2021, the Federal Reserves and many analysts, they were saying, don't worry, many of the supply issues in 2022 will be fixed and the pandemic will be over and be back to business as usual. But what can we see now? Cases are at record levels. We're seeing ports being shut down and we're seeing flights being cancelled, and this is causing huge disruptions in the global economy. And this is leading to weaker consumer confidence and some companies not being able to get their goods in time and leading to lower revenue. Lower revenue, lower profits lead to lower stock prices. Now number 2 is QE winding down and inflation. We're continuing to see inflation go higher and higher, and I think it's going to rise even more in early 2022. And this is leading the Federal Reserve to accelerate its taper of its asset purchase, which will eventually lead to 0 in March, and then they're also going to start lifting interest rates. Now what happens when they do this? This means yields on US treasuries tend to go up, and the higher the yields and interest rates go up, that has a big effect on stock market valuations and risk premiums. Now coming in at number 3, and this is something very concerning for me, is margin calls. We've seen in 2021 that margin has skyrocketed to record highs. Listen to this everyone. Wall Street should be deeply concerned about the rapidly rising levels of margin debt with the amount of money that's been borrowed by institutions or investors with interest to purchase or short sell securities. Over time, it's perfectly normal for the nominal amount of outstanding margin debt to climb. But since March 2020 low, the amount of outstanding margin debt has come close to doubling, and it now sits at nearly 919 billion. And why should we pay attention to this indicator, everyone? Because of this. There have only been 3 instances in the last 26 years where margin debt outstanding rose by at least 60% in a single year. And like I've been covering extensively on the channel, we're starting to see many links between the market today to the dot-com bubble. It happened just months before the dot-com bubble burst, almost immediately ahead of the financial crisis and in 2021. So if stocks do drift lower, all these people that are highly leveraged on margin, when there's a sell-off, this will make the sell-off accelerate. Like what we see with Bitcoin and cryptocurrencies, when there's huge amounts of liquidations, we see prices can fall anywhere up to 20% in a single day. And it was margin calls what made the stock market crash so quick in 2020 when we had drops of 13% in a day. But that's not all, everyone. There is just simple fundamentals in markets that eventually people have to go back to. And so the 4th risk is a sector rotation. Now, what have we seen in the stock market as of late? There's been a huge rally in the large cap tech stocks, and these companies make up a huge weight of the S&P 500. Just the top 10 companies make up 28.5% of the index. So if people rotate out of these stocks, take some profits, and go into better valued companies or also dividend valued companies, even though they're not leaving the stock market, this could cause a huge fall in the S&P 500 simply because how these stocks are weighted. For example, Apple and Microsoft alone make up 12% of the index. Now number 5, meme stocks. Now the Federal Reserve recently came out with a financial stability report in relation to meme stocks and how this can affect the markets. Even though these grossly overvalued companies that have been detached from their respectively poor operating performances, the Fed noted in its semi-annual financial stability report that near and long-term risks exist with the way young and novice investors have been putting their money to work. In particular, the report highlights that households invested in these social media driven stocks tend to have more leveraged balance sheets. If common sense prevails and these bubble-like stocks begin to deflate, these leverage investors may have no choice but to retreat, leading to increased market volatility. And this is something I definitely saw on YouTube 2021. We saw many people get into these meme stocks, and unfortunately many people got into them on leverage, or they use options, and they got what's called wrecked. Now the sixth risk, again, simple fundamentals of valuations. We're seeing valuations are at crazy high levels. And just like in the dot-com bubble when I was saying, don't worry, valuations no longer matter. At the end of the day, once the euphoria is out of the market, valuations do matter. So I'll bring up a chart here. We can see the S&P 500 Shiller PE ratio is at 39. And there's only been one other time in history when it's been higher. Again, the dot-com crash. So people, are you starting to get the picture? We are completely over leveraged, overvalued, and a correction has to come soon. And if we look back at history, it says here the S&P 500 has declined at least 20% in each of the previous 4 instances when the Shiller PE surpassed 30, and we're well past 30 at 39. Wall Street simply doesn't have a good track record of supporting extreme valuations for long periods of time. So again, people, they can have these crazy valuations for a short period when there's all the euphoria in the markets, but they can't sustain these for a long period. And this leads us to our seventh and biggest risk of all: history is making its presence felt. Since 1960, there have been 9 bear markets. That's where there's a drop of 20% or more. Following each of the previous 8 bear market bottoms, the S&P 500 underwent either a 1 or 2 double-digit percentage declines in the subsequent 36 months. And why should we pay attention to this, everyone? Because it's now been 21 months and we haven't even seen a 10% correction in the S&P 500. This is something unheard of. And that means with all the risks that are mounting up, we're getting closer and closer and are really overdue for a correction or even a bear market in the S&P 500. So everyone, what does this mean for you and me in simple terms, and how can we prepare? What this simply means is the risks are mounting up higher and higher and higher. Now, people could avoid all the risks and avoid all the fundamentals when the Federal Reserve was printing money like crazy and when interest rates are at 0. But once the Federal Reserve takes away all this easy money and we start to get back to a more normal market with no more stimulus and no more fiscal stimulus, well then people have to go back to the fundamentals. This doesn't mean I'm telling you to go ahead and sell all your stocks and go 100% in cash, but it may be a good idea to start accumulating some cash on the sidelines to buy the real dip. Because again, it seemed like all the investors, they were just buying every 1 or 2% dip. They were going, oh, look at this, it's such a big bargain, when people, the real bargains are yet to be made. So everyone, what do you think about these 7 signs and 7 warnings? Will they lead to a stock market crash? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.